Welcome back to the channel. I'm Algabot, and today we're taking an educational look at a MetaTrader 5 expert advisor called Macd Volatility Zone Pullback. This strategy is built around a volatility-normalized version of the classic Macd, an approach often called Macdv, and it is designed as a with-trend continuation method. Over the next few minutes, we'll break down how it reads momentum, how it gates its entries with a trend filter, and how it manages risk using ATR-based stops and trailing logic. Everything here is for learning purposes only, so let's walk through the mechanics together, step by step. Let's start with the big picture. Macd Volatility Zone Pullback is a continuation strategy. That means it does not try to call tops and bottoms. Instead, it waits for a trend to already be in place, then looks for a brief cooling off in momentum before the move resumes. The idea is to join an existing trend after a small pause, rather than chasing a market that has already stretched a long way. The engine behind it is the volatility-normalized Macd. A standard Macd is measured in raw price units, so its swings mean very different things in a calm market versus a wild one, and the same number is never really comparable across time or across instruments. This strategy solves that by dividing the Macd line by the average true range and scaling the result by 100. Now the oscillator sits on a stable, regime-independent scale with clearly defined zones. Above zero means momentum leans bullish, below zero means it leans bearish, and a band near plus or minus 150 flags an overextended or exhausted condition. That normalization is what makes the readings consistent enough to keep risk controlled. On top of the oscillator sits a trend filter built from a 50-period exponential moving average. The strategy only considers long setups when that average is rising and price is trading above it, and only considers short setups when the average is falling and price is below it. This keeps the strategy aligned with the larger direction rather than fighting it. In terms of who this style tends to suit, it leans toward patient, trend-following traders who are comfortable waiting for several conditions to line up before anything happens. It runs on a single time frame, and it was designed with liquid forex pairs and index markets in mind, somewhere in the 15-minute to 1-hour range, although nothing in the code is hard-coded to a specific market. Remember, this is educational information only, not financial advice, and like any approach to the markets, it experiences losing trades as well as winning ones. Now let's walk through the exact logic, and it all evaluates on the just closed bar, so the strategy is not reacting to an unfinished candle. First, it builds the oscillator. It takes a fast exponential moving average of the close, subtracts a slow exponential moving average, and that difference is the raw Macd line. It then divides that line by the average true range and multiplies by 100 to produce Macdv. Finally, it smooths Macdv with a short exponential moving average to create the signal line. For a long setup, three things must agree. The trend gate comes first. The 50-period trend average must be rising, and the closing price must be above it. Second is the momentum regime. Macdv must be above zero, confirming momentum is on the bullish side. Third is the reset itself. Macdv must cross back above its signal line. That crossover represents momentum cooling during a pullback and then turning back up in the direction of the trend. There's also a guardrail. If Macdv is already at or above the overbought level of 150, the strategy stands aside because it does not want to enter an already stretched move. The short setup is the precise mirror, a falling trend average with price below it, Macdv below zero, a crossover back down through the signal line, and Macdv no lower than negative 150. Risk is deliberately conservative. When a position opens, the stop loss is placed at 1.4 times the ATR away from entry, and the take profit is set at 2.6 times the ATR. That gives a planned reward to risk of roughly 1.9 to 1. From there, three management rules kick in. Once price moves 1 ATR in favor, the stop is pulled up to break even, removing the initial risk. Once price runs about 1.4 ATR in favor, an ATR trailing stop begins, and that trail only ever ratchets in the trade's direction, never backward. Finally, there is a regime flip exit. If Macdv crosses back through the zero line against an open position, the strategy treats the trend thesis as broken and closes immediately rather than waiting for the stop. And importantly, it only ever holds one position at a time, so it never stacks new entries on top of an existing trade. Let's read through the core of the MetaTrader code as it would appear in MetaEditor. At the top are the inputs. Fast period, slow period, and signal period define the Macd and its signal line. ATR period controls the volatility normalization, trend period sets the 50-bar trend filter, and OverboughtLevel is the exhaustion threshold at 150. AtrStopMult and ATR-scaled size the stop and target from volatility, and lots is the trade size. Next, you can see the two crossover checks. Cross-up is true when Macd was at or below its signal on the previous bar and is now above it. Cross-down is the opposite. These capture the momentum reset. Just below, the trend gate defines uptrend as price above a rising trend average, and downtrend as price below a falling one. Now look at the two entry lines. The go-long condition combines everything: an uptrend, Macd above zero, a fresh cross-up, and Macd still at or below the overbought level. When that is all true, the code enters at the ask, places the stop-loss 1.4 ATR below entry, sets the take-profit 2.6 ATR above, and calls trade.buy. The go-short condition is the exact mirror: a downtrend, Macd below zero, a fresh cross-down, and Macd no lower than negative 150. That path enters at the bid, sets the stop above and the target below, and calls trade.sell. Both sides use the same ATR-based sizing, keeping the risk framework symmetrical. Let's bring this to life on the chart. On top, you can see the price candles with the blue trend average running through them. And in the panel below is our Macd oscillator in gold, along with its signal line in blue. Watch the -0 line in the middle and the overbought and oversold bands near plus and minus 150. Look at the first few candles. Price is stepping higher, the trend average is sloping upward, and price is holding above it, so the trend gate is leaning bullish. Down in the panel, Macd is well above zero, confirming that momentum is on the bull side. So far, everything is aligned for the long side, but there is no signal yet because we still need the reset. Now watch the pullback. Price stalls and pulls back for a couple of candles, and notice what happens in the oscillator. Macd rolls over and dips down until it slips below its signal line. That is the momentum cooling off, exactly the pause the strategy is waiting for. Then, on the fifth candle, price turns back up with the trend, and Macd crosses back above its signal line. All four conditions now agree. The trend average is rising with price above it. Macd is above zero. We have a fresh cross up, and Macd is comfortably below the 150 overbought level, so the move is not considered exhausted. That is where the buy entry marker appears. From there, the stop loss sits 1.4 ATR below entry, and the take profit sits 2.6 ATR above, that roughly 1.9 to 1 reward to risk we mentioned. Price runs higher over the next couple of candles. As it advances 1 ATR in our favor, the stop is pulled up to break even, and as the move extends, the ATR trail begins to follow behind it. On the seventh candle, price reaches the take profit target, and the long trade closes there. Now the character of the market changes. Price rolls over from its high, and in the panel, Macd falls sharply and crosses down through the zero line. This is the regime flip. The trend average tops out and begins to slope downward, and price closes back below it. The bullish thesis is gone, and the strategy now only considers the short side. Watch the mirror image unfold. Around the 10th and 11th candles, price makes a small counter-trend bounce. In the oscillator, Macd ticks back up and rises above its descending signal line, a brief cooling of the downside momentum. Then, on the 12th candle, price resumes lower and Macd crosses back down through its signal line, while staying above the negative 150 band. The trend average is falling, price is below it, momentum is below zero, and we have a fresh cross down. That is the sell entry marker. The stop loss is placed 1.4 ATR above entry, and the take profit 2.6 ATR below. Price then works its way lower, break even, and the trailing stop follow along behind it. And on the 14th candle, price reaches the downside target, closing the short. Two trades, both taken only after the trend, the momentum regime, and the reset all lined up together. So that's a full walkthrough of the Macd Volatility Zone Pullback Expert Advisor. We covered how it normalizes the Macd by the average true range to create a stable, comparable oscillator, how it gates entries behind a 50-period trend filter, how it trades a momentum reset back through the signal line, and how it manages risk with ATR stops, a break-even lock, a trailing stop, and a regime flip exit. Remember, everything in this video is educational information only and not financial advice, a recommendation, or a solicitation. Trading always involves risk, and losses are a normal part of it. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like us to explore next. You can find more at www.overboughtlevel. Past performance does not guarantee future results. Trade responsibly.